This is Quent Bilo with a discussion about topics in Chapter 9, Accounting for Receivables. We've previously made entries for a receivable account. It's a current asset, a promise of a customer to pay later, but we'll examine additional issues in dealing with this customer promise related to collectibility. Our discussion will revolve around the first three study objectives. Again, we'll hit the first two boxes here, types of receivables, and we'll get into recognizing receivables and their collectibility. We'll show that we can value a receivable account at an amount different than its original value, but we'll hold off on detailed discussions of different approaches for populating a new account. That will be covered in a separate discussion. But we'll introduce the use of a valuation or allowance account that modifies the main account receivable balance, reduces its expected collectibility. First, different types of receivables. All of these are amounts due from individuals and other companies that are expected to be collected in cash. They're a customer promise. The one that we looked at previously, amounts owed by customers resulting from the sale of goods and services. This is an oral promise known as an account receivable. We can also have claims for which a formal written instrument of credit are issued as proof of debt. This formal asset is a note receivable, generally having interest attached to it as well. And lastly, there can be other receivables on the books of a company, non-trade, such as interest receivable, loans to officers, etc. So we have listing of other receivables. These are commonly reported differently in balance sheets. First, just to show the perspective of receivables for some companies, we can see that as a percent of total assets, receivables can be quite large. General Electric, 52% of their total assets are tied up in these promises to pay in the future. So this is a significant current asset for some companies. There's three accounting issues related to receivables. One, recognizing them, recognizing this promise to pay later. Secondly, valuing that receivable, that is, estimating any uncollectible portion. And lastly, disposing of accounts receivable, selling them before their maturity. In this discussion, we'll primarily concern ourselves with objective 1 and 2. As we create assets in a sale, create an account receivable, and modify its value. Disposing of receivables will be covered in a separate topic, separate discussion. So, recognizing accounts receivable. Service organizations are providing services, and when they do it on account, they're creating this asset to be paid later. Merchandisers are selling goods, and at the point of sale, the goods are delivered, but the payment for them will become later. So both of these transactions are on account. The customer will pay at a different time. Let's illustrate some common entries affecting receivables. First example, DoorDash Company on July 1st, 2012 sells merchandise on account to a customer Polo Company for $1,000. Terms, 2% 10, net 30. That is, they'll take a 2% discount if they pay within 10 days. Otherwise, the full amount is due in 30 days. Let's prepare the journal entry to record this transaction, this sale, on the books of DoorDash Company, the seller. Debit accounts receivable, $1,000. It's an increase to the asset account with a debit. And credit sales revenue, $1,000, increasing the sales account within the owner's equity category. Next example, on July 5th, the customer returns merchandise worth $100 to DoorDash Company. They're returning this before their promise to pay is due. And we'll just cover the retail entry only affecting the receivable account in this example. So DoorDash will debit sales returns and allowances, $100. That's a contra sales account. And they'll credit accounts receivable, $100, reducing the asset. And the debit to sales returns and allowances will reduce the net sales valuation in the income statement. On July 11th, Jordache receives payment from Polo for the balance due. In this case here, Polo is going to earn a 2% discount since they're paying within 10 days. Jordache is going to receive $882 of cash. They're going to debit sales discount, $900 times 2%, discount earned by the customer, and credit accounts receivable for $900, or the balance due in that account from Polo. Again, sales discount is a contra sales account appearing on the income statement, reducing sales, lowering it for the offered discount that was earned by the customer. We do relieve the full receivable balance since that was the terms of the sale. They earn the discount, and therefore the full $900 remaining is extinguished in this transaction on the 11th. Let's now switch to valuing accounts receivable. Again, this is a current asset, a very important current asset for some companies. In the valuation process, we're going to introduce a new account to show net realizable value. We're dealing with the uncollectability of certain accounts receivable. Any sale on account, credit sales, raises the possibility of the account not being fully collected. Sellers record losses that result from extending credit, and it's known as bad debt expense. So when we speak of uncollectible accounts or doubtful accounts or bad debts, these are interchangeable terms. Ultimately, we're trying to book an expense for account receivable promises that are broken or expected to be broken. Let's first examine the nature of expense. It's a cost of assets consumed or services used in the process of earning revenue. It's like priming the pump. This term comes from the operation of older pumps where a suction valve had to be primed with water so the pump could function properly. In effect, giving up some assets to create more assets. What's the relationship to receivables? Well, credit sales can encourage sales revenue. Buying now and paying later, that's a very attractive term to customers. But this revenue boosting practice introduces a new business risk, a new operating expense. Some promises to pay will not be collected. In other words, we'll have bad debt expense associated with some customer credit accounts that will not be fully collected. The accounting issue is when this expense, this bad debt expense, will be recognized. When will we book it? We have two choices. Book it now or book it later. But what principle should guide us in deciding when we should record this bad debt expense? Let's go back to the matching principle that we saw in Chapter 3, letting expenses follow the revenues. That is, expense recording can be tied to revenue recording. Failure to record bad debt expense now, when sales revenue is booked, will overstate profit in the current period because it will have revenues, sales revenues, but no associated costs such as bad debt expense. And it will also understate profit in later periods when a certain customer proves that they will not pay us. We'll have costs without the associated revenues. So back to the when question as we examine two different methods for valuing accounts receivable. The two methods for accounting for uncollectible accounts, one is called the direct write-off method, the second is called the allowance method. The direct write-off method is one that waits until later. That is, waits until it's known which specific customer will be proven not to be paying its promise to us. The allowance method, we act now, we estimate the losses that will occur in advance. That provides a better matching, meaning a better matching of expenses to revenues. It also states receivables at a cash realizable value using a new account. Any allowance method is required by generally accepted accounting principles. The direct write-off method, as we'll see, has no matching of revenues and expenses. It is not acceptable for financial reporting. However, the IRS requires this method when doing tax returns. So let's examine the allowance method, where losses related to uncollectible accounts are estimated in advance to get a better matching of expenses against the revenues in the current period. For the allowance method, there are 3 accounts involved and 2 stages. What are the 3 accounts? We'll have a bad debt expense account. We'll have an allowance for doubtful accounts. This is a credit account. It's an asset. It's called a contra asset account. It's going to modify our main accounts receivable account, our asset account, which we've seen before. So 3 accounts: bad debt expense, allowance for doubtful accounts, and accounts receivable, our main asset. The bad debt expense and the allowance for doubtful accounts are new accounts that we're seeing in this chapter. The allowance for doubtful accounts is often called a valuation account. It will value or reduce the value, rather, of the gross accounts receivable stated in the main asset account. In terms of the stages, we have 2 stages: an estimate stage and an actual stage. In the estimate stage, we'll book an expense on an estimated basis. We'll book the expense before it actually occurs, before we actually abandon or write off a specific account receivable. The actual phase, the actual stage, is when we literally take off a bad receivable account from our books. These stages are active time frames. They're related but with distinct purposes. It's not precisely static. They can overlap in their various journal entries. Let's look at the first stage. The first stage, we'll recognize a bad debt expense before we learn which account will not be collected. We do this on an estimated basis because in the estimate stage, we don't know which of several hundred, several thousand accounts receivables will not be fully collected. So in the estimate stage, we'll do a debit to bad debt expense, increasing bad debt expense, which reduces the owner's equity category. And the credit will be to this new allowance for doubtful accounts, this contra asset account. We'll increase this allowance account with a credit. We learned earlier that any increases to an account is its normal balance. So a credit balance is the normal balance for the allowance for doubtful accounts. Later, when a specific account is determined not to be collected, and this could be months later, it could be years later, the entry will be to debit the allowance for doubtful accounts, decreasing it, and credit the main receivable account, accounts receivable, decreasing it. A company may not formally take off a bad receivable for years later, in the meantime trying to collect on it. But when it is abandoned, given up, it has to reduce the account receivable account, and it uses the credits previously established in the allowance account as its other side of the entry, the debit. So again, the first stage is estimating the expense associated with a receivable that may not be collected in the future. Debit expense, credit the allowance for doubtful accounts. This is the point where assets are reduced. The allowance for doubtful accounts, being a contra asset account, modifies the receivable, and so total assets decrease in this entry. That's why it has an effect in the income statement, an expense effect. The second stage is actually removing a bad account from our balance sheet, reducing our receivables with a credit, and then reducing our allowance for doubtful accounts with a debit. This middle account, this allowance for doubtful accounts, meets both stages in the middle. In fact, whatever is increased or built up, populated during the first stage is used in the second stage when an actual write-off is known. We don't enter the second actual stage until we know a specific account is not collectible. In the first estimate stage, we may have hundreds or thousands of receivables. We don't know which one will not pay, but we'll make an estimate based on prior experience. The allowance for doubtful accounts is populated in the first estimate stage and depopulated in the second actual stage. In the end, we record a bad debt expense in one period, an earlier period, but delay the actual removal of the specific accounts receivable until we isolate which customer will not pay us. So in the end, though, we're debiting expense and crediting our asset. There's a dynamic here because the actual write-off experiences will inform our future estimates of doubtful accounts. So the increase to the allowance account and the decrease, these are not in lockstep precision, but they are related over the long term. How are these accounts presented on the balance sheet? Accounts receivable on the left, a main asset account. Our allowance for doubtful accounts on the right, with a credit balance. That's the normal balance for that allowance account, that contra asset account, a credit balance. Here we have receivables of $500, and we had a previous estimate of $25 that might not be collected from that $500 main asset. On the balance sheet, we present our accounts receivable in the current asset section, and we reduce it for $25, the allowance for doubtful accounts. So that allowance account is a valuation account. It modifies the value of the main accounts receivable. It is a credit deduct from accounts receivable, not identifying any particular account, just having a doubt that certain accounts will not be collected in the future. The resultant net number, 475, is a cash net realizable value of receivables. So we've reduced our main asset without identifying the specific account that may not be collected in the future. This is the primary benefit of the allowance account in the allowance method. It serves to reduce the expected cash net realizable value of receivables. And as indicated, it's commonly called a valuation account. Valuing accounts receivable downward. An alternate presentation is to, on a single line, show the allowance account amount. So the net of 475, either presentation on the balance sheet is acceptable. Let's look at a series of journal entries from start to finish. We will demonstrate how the allowance method of accounting for bad debts works. We'll record sales, collection of sales, estimating more bad debt expense, doing a write-off of a specific account. We'll demo all the journal entries, but we'll only show the T account activity on the receivable-related accounts. Let's begin with our $500 balance of account receivable and a $25 credit balance in our allowance for doubtful accounts. So first new entry, we have an additional credit sale for $100. Recording debit accounts receivable, $100 debit asset increases that, and credit our sales account. That credit increases the sales or owner's equity category of our equation. Effect on the receivables, increase of accounts receivable, $100. We've created a new asset because we made a sale. Next entry, we've collected $333 on account. That is, customers have paid us for previous entries made on a credit basis. We debit cash for $333, credit accounts receivable. As we post that to the ledger account, receivables goes down by $333, the collection. Again, we're just showing the effect on the receivable side of the balance sheet, not the full entry is being shown here in the T account format. Next entry, we adjust our estimated bad debts in the future for $15. Again, we're anticipating some accounts in the future not being collected. We're going to book these today to get a better matching with the revenues that we're recording today. So debit bad debt expense, $15. Credit our allowance for doubtful accounts, $15. How does that affect our T accounts? It increases our allowance for doubtful accounts, the credit balance, from $25 to $40. That increase in the allowance account, that credit increase, brings the net value of receivables down. Again, we're not showing all the T accounts here, just those concentrating on the receivable-related effects. Now we have a write-off of a specific uncollectible account for $10. Now we know which account, after several unsuccessful efforts to collect them, so we're going to abandon the account, we're going to write it off, $10 worth. We're going to debit our allowance for doubtful accounts, $10, and credit our account receivable for $10, again for a specific account. How does that play out in our posting on T accounts? We see our reduction in the main receivable account, $10 credit on the left, and a debit of $10 to the allowance for doubtful accounts. Note that we are affecting two asset accounts in opposite directions. So the net effect on this is to show the net balance of $227. We have a balance in receivable account of $257 and a balance in our allowance for doubtful accounts of $30, netting to $227 on our balance sheet. So to recap the allowance method for uncollectible accounts, companies estimate the uncollectible accounts receivable now. They don't wait until they know which ones will not be collected. They make an estimate based on experience. They do this by debiting bad debt expense and crediting the allowance for doubtful accounts, a contra asset account. The allowance method does not wait until specifics are known, but estimates based on our experience. So we're adjusting the allowance account upward with that credit to the allowance account. That's what brings the net asset value down on our balance sheet. Later, when companies remove a specific account, they will debit the allowance account. In effect, they're using credits built up in there, so this reduction is used in the debit entry to allowance, and the credit is to the main receivable account receivable. It's written off. The receivable account is reduced because we're abandoning efforts to collect on it. For instance, a customer may have filed bankruptcy showing that they have no possibility of paying us. But again, the abandonment of an account receivable is in a later time stage, what I call the actual time stage, when we actually know what specific account will not pay us. They'll not make good on their promise. Now, write-offs always refer to a specific customer account contained within the accounts receivable asset. An account whose collection efforts are being given up, abandoned, taken out of accounts receivable ledger in this later time frame, what I refer to as the actual time frame, when we actually know which receivable will not be collected, which customer will not pay us. We might not know this for months later or even years later. Different companies have different thresholds of time before they actually remove an account receivable that they determine will not be collected. Let's look at a different illustration. Hampson Furniture has credit sales of $1,200,000 in 2012, of which $200,000 remains uncollected in accounts receivable at December 31st year end. The credit manager makes an estimate that of those $200,000 of receivables, $12,000 yet to be collected will prove uncollectible. So to get a matching, we're going to make an entry at year end before we close it out. We're going to debit bad debt expense for $1,200. This is on an estimated basis. And we're going to credit our allowance for doubtful accounts, $1,200. So the debit to bad debt expense is an estimate in advance of known defaults. And the credit to the allowance account is loading this allowance account up with credits, which reduces our asset. Whenever we reduce our assets in the course of seeking profitable operations, the opposite side is an expense that reduces owner's equity. How's our balance sheet look at year end? Here's our main account receivable, $200,000, reduced for our allowance for doubtful accounts, our contra asset account, $12,000, net amount $188 in our balance sheet. Now, much later, we learn that a specific account will be removed because it demonstrates that it will not be collected. So the Vice President of Finance for our company, Hampson, authorizes a specific write-off of a $500 balance from customer R.A. Ware. What's the entry we make to record this write-off under the allowance method? Debit, allowance for doubtful accounts, $500. We're using part of the credit balance that was built up during the estimate stage. Credit, accounts receivable, $500. We're removing the R.A. Ware balance from our receivables with a credit to receivables. Assets goes down due to a receivable credit, and our allowance for doubtful accounts, that in effect is going down with a debit. Normal balance is a credit, it's going down with a debit. This shows the effect in our T accounts, our write-off, the debit to receivables, reducing it. The credit to receivables, reducing it, and the debit to the allowance account, reducing that account from a normal balance of $12,000 down to $11,500. Our receivable account went from $200,000 down to $199,500, indicating that we've taken out the R.A. Ware receivable from our main receivable account. This write-off is affecting two asset accounts in opposite directions. Before the write-off of the actual uncollectible account, what was our net realizable balance? It was $188,000. $200,000 in the main asset, less $12,000 in the allowance account. Now, what's the balance in that after the write-off of an actual account? The net realizable value is the same, $188,000. We've reduced our main receivables by $500. We've also reduced our contra asset account by $500. So the main account went down $500. The contra asset account went $500. That is our allowance account. Net effect is no change in assets. A write-off entry affects two asset accounts in opposite directions. It's a balance sheet entry only. It does not affect the income statement. So to repeat, the actual write-off of a specific uncollectible account receivable does not affect the net realizable receivable balance of assets, and therefore it does not affect the income statement. Total assets does not go down in a write-off because the write-off entry affects two different asset accounts in opposite directions, debits and credits. They offset each other. Let me repeat. Actual write-offs of an uncollectible account in the allowance method does not reduce the net realizable receivable asset on the balance sheet. Such write-offs deal with two asset accounts, decreasing the main accounts receivable with a credit and decreasing the contra asset allowance account with a debit. In effect, the debit to the allowance account is using parts of the previous credit estimates built up in this contra asset allowance account. The allowance method is all about this new allowance for doubtful accounts account. Just reminding us of the T account balances. The write-off removes a specific receivable from our main receivable account with a credit and removes part of the $12,000 credit balance in the allowance accounts with a debit. Net asset position is unchanged. And so if asset positions are not changed in the actual write-off mode, there's no income statement effect. Expense recording, in other words, when the income statement was affected, occurred earlier in the estimate mode when the allowance account was loaded up with credits. That's when assets were lowered and when the income statement was affected with a bad debt expense. Not in the actual write-off mode later when a specific account is identified as not being collectible. Let's discuss a subsequent recovery of an uncollectible account under the allowance method. That is, we've written off the R.A. Ware customer. We thought we'd never collect from them, and all of a sudden he comes back and pays us. Well, great, we rejoice that he's paying us. What entry do we have to make? First of all, we're going to reverse our previous write-off entry. We're going to restore our accounts receivable for R.A. Ware, debit of $500, increasing the receivable account, and we're going to restore our allowance or doubtful accounts $500. Both of these accounts are restored, in effect, by reversing our previous write-off entry. we'll use that additional credit now in allowance for doubtful accounts for some other accounts in the future that might prove to be uncollectible, but not for RA Ware. RA Ware has paid us. Now that we've restored our receivable account, let's collect it. Debit to cash $500, credit to accounts receivable $500. Note that our subsequent recovery does not affect our income statement. All of these accounts shown here, the receivable account, the allowance account, the cash account, are all balance sheet accounts on the asset side. Nothing is affected in the income statement. Balance sheet entries only. Rearranging our asset positions. This is a two-step process. We reinstate first, increasing receivables, increasing our allowance account, and then collect the cash. Looking at this write-off in our equation diagram, in effect, we're just rearranging assets. It does not affect owner's equity. There is no reversing of any expense. So when an account receivable that was written off earlier as worthless now all of a sudden becomes collectible, to our delight, of course, we reverse the previous write-off entry, we restore our accounts, we restore the debit to the receivable account, the main asset account, and restore the credit to the allowance account, and then collect it. Debit cash, and then lower accounts receivable with a credit. Again, remember that the allowance account is in the asset category. It's a contra asset account. This is the end of our allowance method discussion. Let's discuss the direct write-off method. Now, this is not generally accepted accounting principles, not GAAP. It is not the preferred method. Why? Because it waits until we know that a specific account is uncollectible before making any entries related to bad debt expense. This method waits, and there therefore is no matching of the risk of doing business in a credit sales. There's no expenses booked in the same period that sales are booked. This waiting creates a very large timing gap between revenue recognition currently and the cost of doing business on credit, which is our bad debt expense. In other words, this method distorts the measurement of periodic net income. We are not matching cost of doing business in credit sales during the period in which we recognize the revenue, but in different periods. So there's no use of an allowance account in this method. There are no estimates made in advance of finally abandoning a specific account receivable balance later. We wait until we know what that is, even if it takes a year or longer before we abandon it. So illustrating the direct write-off method, Ward & Company writes off a specific customer account, M.E. Dorans, for $200 as uncollectible a year later after they made a sale to them, a credit sale. What is Warden's entry to write this off under the direct write-off method? First of all, they've waited a year later after the sale was booked, and now their entry is going to be debit bad debts expense, $200, credit accounts receivable, $200. Receivable credit brings that asset value down, and it's entirely expensed the bad debt expense, bringing down owner's equity. In this case here, as indicated, there is no matching between the revenues booked a year earlier and the cost of doing business on a credit basis. The receivable was not stated at a cash net realizable value because no allowance account is used in the direct write-off method. And as indicated, this method is not acceptable for financial reporting. It is not generally accepted accounting principles, not GAAP. The hallmark of this method is that it waits until a known specific account is deemed uncollectible before any expense is recorded. It's very simple to use. There's no bad debt expense recognized until we identify a specific account receivable that will be abandoned, dismissed, written off. That's the point that an entry is made, debiting expense and crediting the asset account. Now, the IRS insists on use of this method when filing tax returns. There can be a difference between the earnings on a company's books and the earnings declared in a tax return. That's commonly expected in large corporations, and there's actually a Schedule M that reconciles the two. The IRS is not necessarily concerned with proper accounting principles such as the matching principle. They believe that use of the allowance method might cause a company to manipulate their net income, create expense deductions that might not be borne out with future experience. So the IRS on tax returns will not accept a bad debt expense that comes directly out of the allowance method. They insist on having an account abandoned before bad debt expense is declared on the tax return. But this is a financial accounting course. This is not a tax return course. Well, this ends our discussion of the two methods of recognizing bad debt expense, the allowance method, which is GAAP, and the direct write-off method. There'll be a separate discussion which will demonstrate two different approaches or bases for using the allowance method. That'll be in a separate narrative.